Hey tech enthusiasts, welcome to the Friday edition of Tech Stocks Daily. Today we're diving into Google's nail-biting antitrust court battle, Microsoft's big moves, shutting down the Xbox Ambassadors program and grabbing headlines with a nuclear power deal, Zoom's roller coaster stock ride despite solid earnings, and Synopsys' surprising dip following a mixed earnings report. Stick around to get the scoop on these headline makers and find out whether Google's legal drama means it's time to buy, hold, or sell their stock. Buckle up, it's a tech news whirlwind. All right, folks, grab your popcorn because today we've got a Google drama that's juicier than any primetime reality show. Yes, we're diving deep into the complex world of tech giants, antitrust battles, and some seriously shady emails. Let's talk about why Google is feeling the heat in the courtroom today. The saga began in the federal courtroom in Virginia, where the Justice Department is wrapping up its antitrust case against Google. Now, if you think this is just another corporate lawsuit, think again. The federal government, backed by a coalition of states, has accused Google of maintaining a monopoly over the online advertising market. This isn't just your regular banner ad kerfuffle. No, we're talking about technology that's integral to virtually every ad you see on a web page. So, what's the crux of the case? The government alleges that Google's domination extends across all stages of the online advertising process. The tech that publishers use to sell available ad space, the vast networks of advertisers who buy that space, and the ad exchanges that serve as middlemen linking those two sides. In short, Google is said to be the master puppeteer, pulling all the strings and closing out any room for competition. Because of this stranglehold, they're purportedly charging an exorbitant 36 cents on every advertising dollar. Oh, but the plot thickens. During the trial, the witnesses have mostly been Google managers and executives. These key figures have frequently disavowed their own digital footprints, the damning emails, chats, and presentations they've authored. A striking example is Jonathan Belak, a Google product manager. In a 2016 email, Belak wondered out loud, is there a deeper issue with us owning the platform, the exchange, and a huge network? The analogy would be if Goldman or Citibank owned the NYSE. Ah, the smoking gun. For the Justice Department, this email perfectly encapsulates their argument. However, Belak has brushed off his email as late-night jet-lagged ramblings, claiming he didn't believe Google's all-encompassing control was genuinely problematic. His fellow Google peers echoed the stance. The emails were not a reflection of the real scenario, but rather speculative musings or misunderstood communications. And there's more. Forbes could publish a book about all the other Google employees who've attempted to distance themselves from incriminating documents, insisting they were taken out of context. What's even more scandalous is the allegation that Google systematically deleted many internal chat records, despite knowing they were under investigation. The Justice Department believes that these documented conversations offer a true snapshot of Google's monopolistic machinations. Judge Leonid, overseeing the case, has criticized Google's document retention policies as absolutely inappropriate and improper. However, she has yet to decide on any conclusive penalties. If this courtroom drama has you hooked, don't go anywhere. It's significant not just because it's about Google, but also because it influences billions of dollars. Yes, billions with a annually. And let's not forget, this Virginia showdown comes hot on the heels of another ongoing antitrust lawsuit in DC, where Google's search engine is labeled as an illegal monopoly. Stay tuned for what happens next as Google gets ready to present their witnesses. Will they manage to wriggle out of this tight spot, or are we watching the beginning of a tech giant's fall from grace? Get your subscriptions activated, and don't blink. You won't want to miss this. Hey tech enthusiasts, buckle up because we've got some major Microsoft news that's been making waves today. First up, Microsoft is shutting down its Xbox Ambassadors program in a move that's got the gaming community buzzing. After an impressive 13-year run, the program will begin winding down, starting now, with a complete shutdown set for October 15th, 2024. If you're an ambassador, you've got until that date to claim any remaining rewards and codes. Now, for the uninitiated, the Xbox Ambassadors program was like a golden VIP pass for some of the most die-hard Xbox fans. These ambassadors weren't Microsoft employees, but were essential to representing the Xbox brand and promoting inclusivity, safety, and fun within the gaming community. To become an ambassador, you needed a minimum gamer score of 1500 and had to be at least 17 years old. Fancy, right? These folks were often rewarded with exclusive digital and physical items, editorial spotlights, and even access to some pretty sweet sweepstakes. But all good things must come to an end, and Microsoft stated that the program's closure is part of adapting to the evolving nature of the Xbox brand. They plan to shift their community engagement strategies through other initiatives like the Xbox Rewards and Xbox Research programs. But it's not all doom and gloom. Microsoft also hinted at expanding their engagement programs with a greater emphasis on events like Xbox Fan Fest and the Xbox Insider program. The company wants to make its community interactions more inclusive and valuable, allowing everyone to live their community values and have fun. Because, let's face it, gaming is all about having a blast. And that's not the only headline Microsoft snagged today. They've inked a massive deal with Constellation Energy to buy power from the 3 Mile Island nuclear plant, which is expected to restart operations by 2028. This isn't just any purchase agreement. Microsoft's deal is the largest that Constellation has ever signed. It's set to be a 20-year agreement, supplying Microsoft's data centers with carbon-free power. Now, why is this a big deal? As tech companies ramp up their AI capabilities, electricity demand from data centers is set to skyrocket. Goldman Sachs even estimated that data centers could consume about 8% of the total US electricity demand by 2030, up from just 3% now. Microsoft, Amazon, Oracle, and other tech giants are turning to nuclear power to meet this growing demand while sticking to their climate goals. The restart of the 3 Mile Island plant is not just significant for Microsoft, but also for the nuclear energy sector, which has seen a resurgence in bipartisan support from federal and state governments. Following a decade-long wave of reactor shutdowns, this marks a pivotal moment in the revival of nuclear power in the US. And that wraps up today's Microsoft saga. Whether you're an Xbox enthusiast, grieving over the Ambassadors program, or excited about the green energy deal, Microsoft is making some bold moves that are definitely worth keeping an eye on. All right, tech enthusiasts, buckle up, because today's tech story zooms right into Zoom video communications. Yes, Zoom is in the limelight following a dip of 1.7% in its stock price since the last earnings report a month ago. It's like having a roller coaster ride at a theme park. Exhilarating for some, stomach-churning for others. So what's turning the tide for Zoom? Let's dive into some numbers with a dash of humor to make it palatable. Now, Zoom's second quarter fiscal 2025 report shows adjusted earnings of $139 per share, shattering the Zacks consensus estimate by a nifty 14.88%, and clocking a neat 3.73% increase year over year. Imagine expecting a small vanilla cone and getting a triple scoop surprise. Revenues, on the other hand, also strutted their way past expectations at $1.16 billion, up by 2.09% year over year. Thank the enterprise customers. They've been the star performers, contributing $682.8 million, a 3.5% rise from last year. In fact, enterprise account holders spending over $100,000 have grown 7%, totaling 3,933 accounts. Looks like Zoom's rapidly expanding client base is bringing home the bacon. Zoom is going full throttle to revamp its operations and user experience by transitioning 2,680 low-revenue customers to its online platform. Post-transition, the tally stands at approximately 191,600 enterprise customers, with a shiny trailing 12-month net dollar expansion rate of 98%. Zoom Rooms have also been buzzing, with over 2 million licenses purchased. It's like they've handed out golden tickets for a tech wonderland. Moreover, WorkVivo, Zoom's workplace engagement platform, has exploded to 69 customers with more than $100,000 in annual revenue, doubling up from the previous year. The cherry on top, WorkVivo was named Meta Platform's only preferred migration partner as Meta retires Workplace from Meta. Talk about a glow-up. Zoom's innovation vein runs strong in its AI investments, yet some points trimmed off the non-GAAP gross margin, which dipped slightly to 78.6% from 80.3% the prior year. Meanwhile, research and development saw a 7.8% spike to $206.7 million, boosting those software specs. Sales and marketing took a back seat with a 3.9% drop to $358.7 million, and general administrative expenses shrank by 15.3% to $109.5 million. On the cash front, Zoom remains solid with $7.5 billion in total cash and marketable securities, and net cash from operations rose by a staggering 33.7% year over year, totaling $449.3 million. Free cash, that's $365.1 million, having surged by 26.2% from last year's quarter. Despite the solid earnings, why then the drop, you ask? Market sentiment and momentum can be like a scatterbrained professor, confusing and erratic. Despite decent earnings and innovations, holding a Zacks rank number 3 suggests mixed analyst forecasts, indicating market stabilization is yet to come. Fingers crossed, Zoom's upcoming financial results and operational efficiencies will help it regain some momentum. Meanwhile, fellow industry player HubSpot counterbalanced Zoom's dip with a rise of 6.7% over the past month. Woohoo! Competitions in tech are dynamic, aren't they? Keep your eyes peeled, folks. We'll be back with more updates on Zoom's groove-tastic journey. All right, tech enthusiasts, let's dive into why Synopsys caught everyone's attention today. Synopsys, trading under the ticker NASDAQ SNPS, has been in the spotlight following a less than stellar performance in the weeks since their last earnings report. Shares have dipped 6.2%, trailing behind the S&P 500. The big question on everyone's mind is, will Synopsys bounce back, or are we in for more turbulence? First things first, let's highlight the positives, because, believe it or not, Synopsys did have some good news. The company reported better than expected earnings for the third quarter of fiscal 2024. Their non-GAAP earnings per share hit $3.43, comfortably beating the Zacks consensus estimate of $3.28. Revenue also saw a healthy 13% year-over-year increase, hitting $1.53 billion and aligning with expectations. But hold your applause for a moment. Despite those hopeful numbers, it's worth noting that the stock still nosedived. What gives? It turns out, investors are jittery about a few things. First up, the discontinuation of their software integrity business. This segment was sold to private equity firms Clearlake Capital and Francisco Partners for a cool $2.1 billion. While Synopsys sees this as a strategic move, divesting this part of their business can be unsettling for shareholders looking for stability. On the revenue front, there's a mixed bag. Time-based product revenues, which compose over half of their total income, were down by 2.9% year over year, even though their upfront product revenues shot up by 51.2%. Add in the fact that their North American revenues rose, but growth in regions like China accounted for a significant 17%, and you're looking at the bigger global strategies at play. The nooks and crannies of their financial report tell an important story too. Despite some positive numbers and robust geographic performance, the company's overall growth score sits at a disappointing D, particularly on the value front. The complex balance sheet, featuring nearly $2 billion in cash and short-term investments, but also a minor but noteworthy long-term debt, adds layers to the narrative. Not to mention, cash flow from operations saw quite a dip when compared to the previous year. So the ultimate question remains, is Synopsys poised for a comeback? With forward-looking statements showing modest expectations for revenue and EPS in their fiscal year, and some confidence in cost management, there's cautious optimism. All right, tech heads, now I want to hear from you. What do you think about Synopsys' current predicament? Are you bullish on a rebound, or do you think more challenges lie ahead? Drop your thoughts in the comments below, because your perspectives always add value to the discussion. That's it for today. Until next time, keep those thoughts rolling in and stay updated with the latest in tech news. Okay, tech aficionados, let's zero in on Google today for a closer look at whether you should buy, hold, or sell this tech titan stock. Grab your thinking caps and let's dive in. Google is currently knee-deep in antitrust litigation, with accusations flying left and right about them running a monopoly scam in the online advertising world. The Justice Department's emails from Google's top executives have some spicy content that could make even the juiciest gossip columns blush. And trust me, the courtroom antics feel like they're straight out of a legal drama series. Despite all this, Google remains a massive behemoth in the tech industry. Their products and services are ingrained in our daily lives. Think Android, Google Search, YouTube. It's virtually impossible to escape. But these legal challenges are not just a slap on the wrist. They could reshape the company's future dramatically. The stock's performance right now might reflect investor jitters about the lawsuit's outcome and potential ramifications. If Google's business practices are deemed monopolistic and need to be altered, it could severely affect their very lucrative advertising model. Given all this turbulence, if you ask me whether to buy, hold, or sell, I'd recommend holding for now. Why? Because while the courtroom drama is intense, Google's fundamental strengths, its vast ecosystem of products and strong market presence remain rock solid. Selling now might lead to missing out on a potential rebound once the dust settles. Buying could be risky if you're not prepared for further dips due to upcoming legal blows. Remember, this is just my 2 cents. Always do your own intensive research and consider your risk tolerance before making any financial moves. So what do you think? Hold on tight or risk making a move? Drop your thoughts in the comments section below. Wow, what a roller coaster of a day on the NASDAQ. From Google's courtroom drama involving potential antitrust violations and spicy internal emails, to Microsoft shutting down the Xbox Ambassadors program while inking a record-breaking nuclear power deal, to Zoom's mixed market vibes despite solid earnings, and the ups and downs of Synopsys' stock movement. It's been a whirlwind of tech news and market data. If you enjoyed this video, hit that like button, subscribe to the channel, and don't forget to share it with your friends. Come back on Monday for more tech updates. Have an amazing weekend, everyone.